Hello and welcome to the webinar. My name is Denise Toby and I'm a partner with Whitfleet in our non-for-profit practice. I have over 30 years of experience in public accounting, and I also lead our non-for-profit training practice and have been training community action agencies for over 20 years. Today's webinar will be cost allocation, including direct costs and approved indirect cost rates. Let's get started. I do need to ask that you not record any of this webinar on either video or audio images. Please note that the materials are incomplete without the accompanying oral comments by the trainer. These training materials were created in collaboration with Whitfleet and the National Association of Community Action Agencies, the Community Action Partnership, as a part of the Partners Performance of the United States Department of Human Services Administration for Children and Families Office of Community Services grant. Let's start with some key terms and concepts. Cost allocation is a challenge for many organizations. Coming up with an appropriate method, understanding when and how you allocate, and using appropriate methods. There are two basic categories of costs. One is administrative costs, the other are program costs. The administrative costs relate to the direction and supervision of the organization, the overall management functions of the organization. And it's not related to direct program services, even though the program benefits from these types of costs. These costs could be allocated both directly or indirectly, and we're going to talk about those two methods in a moment. Program costs or program activities, they directly relate to program component services and functions. This is what the grant is intended to accomplish. It's the direct service that's being provided. It results in goods or services distributed to clients, and it's the major purpose or output of the organization. So is a cost direct or is it indirect? Direct costs, as defined in 2 CFR Part 200, Section 413. Now, 2 CFR Part 200 is the uniform guidance that all non-federal entities that expend federal funds must adhere to. And the definition for direct cost said that it's a cost that is specifically identified with a cost objective. Indirect costs, as defined in 200.414, is a cost that benefits more than one and not specifically identified with a particular cost objective. So these are costs that benefit more than one activity. Now, some of the issues that we have when we're looking at administrative and indirect costs. First is distinguishing between administrative and program costs. Again, administrative costs are those that benefit the program but are not tied to a direct service. Another challenge is distinguishing between administrative and indirect costs. So when you look at the total composition of a program cost, you would have one area of costs that are directly program related. So if we're talking about the Head Start program, it would be a teacher in the classroom. That is a direct program service cost. Then you would also have a program director, the Head Start director. That is also a program cost, but it is administrative to that program. And then we have the indirect costs, the administrative indirect costs are costs that the program benefits from that all programs would share a part of that cost, such as the executive director, the finance department, the HR department, the IT department, the receptionist, the building that all of those people sit in. Those are costs that are administrative to the agency and administrative to the program. And we're trying to find a method, a common method to allocate those costs. Another problem that organizations have are inappropriate recording of costs that may lead to exceeding limitations. So many programs have a cap on how much administrative costs can be charged to the program. And keep in mind, what you have to put into that administrative bucket would be the program administrative costs, such as the program director, as well as the agency administrative costs, the portion of the executive director, the portion of the finance director, the IT, et cetera, as I mentioned before. And another challenge is choosing to directly allocate some administrative costs due to administrative cost limits. So sometimes agencies say, well, I'm not going to direct all of these costs because I'm going to exceed my limit. The problem is then who will or how will you pay for those additional costs? So what is cost allocation? It is the organization's chosen method for fairly allocating costs that benefit more than one cost objective. So the definition of cost objective in the uniform guidance means a program, function, activity, award, organizational subdivision, contract, or work unit for which cost data are desired and for which provision is made to accumulate and measure the cost of processes, products, jobs, capital projects, etc. So we have to say who is benefiting. So it could be a program, it could be a division, it could be a grant, it could be a department. So that's what the definition of a cost objective is. When we're talking about allocation, there can be a lot of different areas that you have to consider cost allocation in your organization. So one might be the first one. Let me pull up an arrow for you, where you would allocate across all grants and activities. So everybody gets a share of a particular cost. You may have to allocate among funding sources in a particular program. So you might have federal money that supports a program and state money that supports a program, and you might have to allocate between those two grants to share part of a common cost. You might have programs from the same funding source. So you might have WIOA programs, youth and adult, and you might have to find a way to allocate amongst those different programs from the same funding source. You may have Head Start and Early Head Start, where you have a cost that benefits both programs, and you're trying to determine a common denominator to be able to allocate those costs between those programs. And it might be categories within a program. Again, maybe allocating between administrative and programs. So there are a lot of ways that organizations have to consider cost allocation. When we consider costs, we have to think about the cost principles. And the cost principles, first, we have to consider whether or not a cost is reasonable. Is it reasonable that we're spending the money on here? And also necessary. Remember, necessary goes with reasonable. And then the second one is it allocable? Is this a cost that I could charge to my program? Then we have to consider different types of costs. Is it a direct cost? Is it an indirect cost? Or is it a cost that I'm allocating using an approved indirect cost rate? And then we have to consider in the selected items of cost whether or not I could charge to this particular program. And there's another webinar that's available on allowable costs and understanding which costs are allowable under the cost principles. So we have to determine whether a cost is allowable, whether it is unallowable, or whether it needs prior written approval. So All of these considerations have to be kept in mind as we're considering a cost. Now, some of the factors that um, affect the allowability of costs. It has to be necessary and reasonable. It has to conform to limitations, has to be consistent with other organization activities, treated consistently, be determined in accordance with generally accepted accounting principles. It cannot be counted as cost or match in any other federally funded program, and it has to be adequately documented. So these are all things that we have to keep in mind when we are trying to determine if a cost is allowable. Now, reasonable, it says that a cost is reasonable if in its nature or amount does not exceed that which would be incurred by a prudent person under the circumstances prevailing at the time the decision was made to incur the cost. So things that we have to keep in mind is it, again, ordinary and necessary. Keep in mind sound business practices and arm's length bargaining, making sure we're paying market prices for comparable goods, making sure that the individuals that are making the decisions that they act with prudence, and that we don't deviate from our established practices, which could unjustifiably increase a cost. So again, all of these things have to be kept in mind when we're trying to consider reasonable. Now, I do want to point out the references on here in case you are not familiar with them. Anything referenced with a 200 point something comes from the uniform guidance. Now, this is the Office of Management and Budget's version that affect all organizations that expend federal funds. When it was enacted in 2014, some departments were allowed to make revisions to the uniform guidance. So the references that I have at 45 CFR Part 75 come from the Department of Health and Human Services version of the uniform guidance. So it depends on which programs dollars you're spending as to which set of cost principles that you need to follow. So we do have both of those references because many of community action agencies funding does come from the Department of Health and Human Services. Now, allocable, this is where we're going to really have to think about cost allocation. And it says that a cost is allocable to a particular federal award or other cost objective if the goods or services involved are chargeable or assignable to that federal award in accordance with relative benefits received. And this is going to have to be a common denominator when you're thinking about cost allocation. The regulations require that you allocate based on benefit received. You don't allocate based on size. When you allocate based on size, all that does is charge the most amount to the biggest program. And that doesn't necessarily correlate to benefit received. So you don't want to have any type of cost allocation methodology that allocates based on total expenses or total salaries. Those are similar to an indirect cost rate methodology that I'm going to talk about in a little bit, but we're just talking about direct cost allocation that says allocate on relative benefits received. Now, one of the things that I do want to mention about cost allocation, and as I said, I've been in public accounting for over 30 years, worked with grant-funded agencies for over 20 years. I'm still an auditor by practice, so I still have audit clients. And what I see is that agencies make cost allocation more complicated than it needs to be. And they spend a lot of time on tweaking it and adjusting it for every payroll, every 2 weeks. And what we'll see in the regulations, it says that it needs to be an approximation. So we want to make sure that we keep this in mind. So it's allocable if a particular cost is incurred specifically for the award. It benefits the award in other work, and can be distributed in proportions that are approximate using a reasonable method. So this is what I'm getting at, that it doesn't have to be exact. In approximate proportions using a reasonable method. So as long as your method is reasonable and it approximates the cost, that's okay based on the regulations. It also needs to be necessary to the overall operation of the organization and assignable in accordance with the uniform guidance. So again, always have to keep the regulations in mind. And then it goes on to talk about that all activities which benefit from the indirect cost or the administrative cost that you're allocating, such as unallowable activities or donated services, have to receive an appropriate allocation. And letter C is very important when we're considering cost allocation. And it says that any cost allocable to a federal award may not be charged to other federal awards to overcome fund deficiencies. So what this means is that you can't stop allocating to a particular program or a particular award just because it limits how much administrative costs that they're willing to pay. As long as the agency is, or I'm sorry, as long as the program is still benefiting from the cost, you need to continue to allocate to that program. Because if you stop allocating to that program just because they can't or won't pay, you're shifting costs to another program and they're paying more than their fair share, paying more than they are benefiting for. So you want to be very careful about that. So one of the things that I tell agencies consistently is you allocate first and ask for reimbursement second. So you have to make sure that you are following your cost allocation methodology. Now, under the direct cost allocation principles, things that we have to keep in mind, it says if a cost benefits two or more projects or activities, in proportions that can easily be determined, then allocate based on that proportional benefit. But if it benefits two or more projects or activities in proportions that cannot be determined because of the interrelationship, then the cost may be allocated on any reasonable, documented basis. So again, has to be reasonable and has to be documented. So, for example, on the first section where it says that proportions can easily be determined. I have two programs. I purchased 5 boxes of paper. I gave 3 boxes to program A and 2 boxes to program B. I know exactly how to allocate that cost. But if I have 2 programs, 5 boxes of paper, and 1 copy machine, then I may not be able to determine the exact allocation. And it says that I can allocate based on any reasonable documented basis. So I go to my policies and procedures and it says that I allocate copy paper based on the codes that are entered into the copy machine when someone uses the copier. That's a reasonable documented basis. Is it exact? Does it mean that somebody couldn't use another program's code when they were to make 5 copies of something? Sure, they could. But is it a reasonable method? Yes. And have you documented it? Yes, if it is in your policies and procedures. Classifying costs. We get this question a lot. So there are 2 ways to do cost allocation. The first is a direct method, and the second is an indirect method. So when we think about a direct method, we're allocating costs based on relative benefits received, and we charge shared costs, again, some of these administrative costs that all programs share in, based on an activity or other non-monetary based. So activity is units of service or other non-monetary base, such as number of employees, number of computers, square footage, number of transactions. Those are all non-monetary base. So if we're using a direct method, it needs to be a non-monetary base. An indirect method is a method to allocate these administrative costs, and it's a method for determining in a reasonable manner the proportion of indirect costs that each program should bear. And it is done through using a ratio of indirect costs and a direct cost base. And we'll explain a little bit more on that in a moment. So we get questions a lot of how do I classify this cost? Is it direct or indirect? Is it program service or is it administrative? And it says that there's no universal rule to do this, but just that you need to make sure that you're treating that cost consistently. Make sure that if you're treating it as an administrative cost, you always treat it that way. If you treat it as program, always treat it that way. So direct cost allocation, it needs to be supported by current data. So what that means is that using historical information may not be the most appropriate way to allocate a cost because that may not be the current activity. We use an example in our trainings about going to lunch. And if 3 people went to lunch and we're trying to figure out how to split the bill, if you're using historical information, you would say, well, let's allocate it the way we had lunch last time. Well, that doesn't make sense because that might not be, what each of us ate this time. So it has to be based on current data. And any cost objective that benefits has to have an allocation, and costs have to be allowable. So you want to make sure that any cost that you are charging is an allowable cost to that program or cost objective. Now, these are some examples of allocating an expense to various programs using a non-monetary base. So we have a vehicle that many programs share. Number of miles driven would be a reasonable non-monetary allocation base. Food preparation, maybe number of meals served. Building maintenance could be allocated based on square footage. So again, think about non-monetary basis and ways that would fairly allocate costs to different programs and programs that benefit. Now remember, we always have to look at benefit. Now, there is a section in uniform guidance that talks about these administrative costs. And it says that salaries of administrative and clerical staff should normally be treated as indirect. So that means that you need to allocate it using an indirect cost rate. And it says directly charge only if all of the following are met. Number 1, that the administrative or clerical services are integral to the project, meaning that they have to be the program can't operate without them. Number 2, that individuals involved can be specifically identified with the project. So we know exactly that these individuals, these administrative and clerical staff, we can see how they are involved with the project. Number 3 says that costs are explicitly included in the budget or have prior written approval. So make sure that you've included these administrative and clerical staff in your budget. And number 4, that the costs are not also recovered as indirect. So that means you can't directly charge and indirectly charge them. Now, indirect costs. They are negotiated rates that must be accepted by all federal agencies. You may use a different rate only when required by statute or regulation. So this is when you've gone out and negotiated to get an approved indirect cost rate. And what's unique about uniform guidance is that it does require all federal agencies to accept it. Now, this is one of the challenges that organizations have had in the past using an indirect cost rate, is that they would go through the effort of getting this rate approved, say approved by the Department of Health and Human Services, and they also have Department of Labor money, and the Department of Labor would say, oh, but we don't accept their rate. You need to do a direct cost allocation methodology for us. And thankfully, the uniform guidance has changed that. So if you go out and get a federally approved indirect cost rate that is used to allocate your administrative and clerical costs to your programs, all federal programs have to accept your methodology. Now, unfortunately, they don't have to necessarily pay it, and we'll talk about those limitations, but your methodology has to be accepted by all federal agencies. Awarding agencies must include in the notice of federal policies relating to indirect cost rate reimbursement, matching, or cost share. So it has to be included in their policies of how much they will accept. Pass-through agencies are subject to 2 CFR 200.331, and that means that pass-throughs have to accept your indirect cost rate as well. And then just as an FYI, Appendix 4 and Appendix 5 talk about cost allocation for indirect cost allocation for nonprofits in Appendix 4 and units of government in Appendix 5. Now, one thing new with the uniform guidance is the introduction of a de minimis rate. Now, the uniform guidance does not require agencies to use an indirect cost rate, but they have provided methodologies that make it easier for agencies to use one. And this de minimis rate is one of those methodologies. And what it says is that any non-federal entity that has never negotiated an indirect cost rate can elect to use a 10% de minimis amount. So it's a minimum rate, it's a 10% rate that gets charged to all of your programs, and you use that charge to pay for your administrative costs. And we'll talk about pools and how those things work, but this is something that is available to agencies if you have never, ever had a negotiated indirect cost rate. Now, another thing new with the uniform guidance, now this is for those that have indirect cost rates, is that you can apply for a one-time extension to lock in your rate for 4 years. So you don't have to go through the process of getting your indirect cost rate approved every year. Now, things to keep in mind is that it has to be approved by a cost negotiator. If approved, you cannot request a rate review until that 4 years is up. So you are locked in. So you're kind of rolling the dice a little bit. But for those whose indirect cost rate hardly ever changes, this might be a good option for you. At the end of the 4 years, then you have to apply for a new rate, and then you could ask to have that new rate locked in for another 4 years. So this is one of the ways that the uniform guidance is trying to reduce the administrative burden for agencies. So under the indirect cost rates, so the difference between the de minimis rate and the negotiated. Let's talk about the de minimis rate first. This is a flat rate that gets charged to your programs without regard to actual expenses. So it doesn't matter what is in your pool. Your methodology to recover administrative costs is to charge everybody 10%. Another good thing about this is that you don't have to have it approved by anyone. You may not recover all your indirect costs, or you might have a residual. So if what you recover using the 10% is more than your costs, then you'll have a little residual. But if it doesn't cover all your costs, then you're going to have to make that up on your own. You also don't have to prove your costs. When an agency elects the 10% de minimis rate, all the funding sources need to know is that you charge them 10%. It does not matter how much is in your pool. It doesn't matter if you're running at 8% or at 11%. everybody gets charged your methodology as a flat 10%. You can only use one allocation base, and that's modified total direct that we'll get to shortly. And you use this rate indefinitely. So if it works for your agency, if you say, we think that just charging everybody 10% would cover our administrative costs, then you should consider using the de minimis rate. You just need to look at what's in your pool and how much you could recover from your various grants to see if it's enough to cover your pool. Now, the difference between that and a negotiated rate is that the negotiated rate is based on your actual expenses, and you have to use your most recent audit report. It has to be approved by a federal negotiator. You allocate all costs that are in your pool. You can't get more than what's in your pool, and hopefully you don't get less than what's in your pool. And you have to provide a detail of what those costs are, because what someone looking at your pool is looking for is they're looking to see whether or not you have any unallowable costs in your pool. You can choose from different allocation bases. So you could use modified total direct, you could use salaries, or you could use salaries in fringe. And with a negotiated rate, it has to be renegotiated every year, although remember you do have that option for a 4-year extension. So how do you calculate your rate? Well, you take your indirect costs that are in your pool, your indirect costs that go in your pool. These visuals are kind of fun. And you divide it by your base, your direct cost base, to come up with a percentage. And that percentage is used to allocate to everyone. Now, the things that you have to make sure of what goes into your pool is that the costs have to be allowable and they have to benefit all programs. So E for everyone. What does not go into your pool? Capital expenditures do not go in your pool. Losses on awards do not go in your pool. Unallowable costs do not go in your pool. And expenditures that benefit some programs but not all do not go in your pool. So that's what goes into the negotiated pool. The de minimis pool is just any costs that you are trying to recover using your 10% de minimis rate. So again, they have to be costs that benefit all programs. And again, you don't have to prove those costs that are in your pool. So these are some examples of costs that might go in your pool: board cost, your IT, maintenance costs, utilities, the executive director, the finance director. These are all costs that benefit all programs, that everybody should pay their fair share to recover those costs. Now, who might be watching your pool? Well, if you look, this is a monitor. Your funding source monitors, little humor there, may be looking at what's in your pool. Who might this be? This looks like your auditor. Your auditor should be looking at what is in your pool. And the government, your actual funding sources, and maybe the cost negotiator are wondering what is in your pool. So everyone should be looking at what costs are in there. And again, the things to keep in mind, they have to benefit all programs and they have to be allowable. There are different types of negotiated indirect cost rates. The first one is predetermined. And a predetermined rate is based on estimated costs that are incurred during the year. So you apply for a rate and they issue you a rate and it doesn't change. Doesn't matter what your actual costs are, we are allocating you or allowing you to use a rate based on estimated costs. Unfortunately, nonprofit organizations do not tend to get predetermined rates. Those are usually set aside for units of government. Another type is a fixed rate with carry forward. So this is based again on estimated costs that are incurred during the fiscal year, and it doesn't get finalized. So any residual or loss that you've had using that rate during the year gets carried over and is taken into consideration for next year's rate. What most non-for-profits get is a provisional rate. So it's a temporary rate based on the information that you submitted when you negotiated your rate. Well, when you get a provisional rate, it has to be finaled at the end of the year. So you have to look to see what was the actual rate. And the challenge using a provisional rate is they may give you a provisional rate of, for example, 20%. But if your rate finals at 18.9, if you have charged your grants 20% and you should have only charged 18.9, you're going to have to pay that money back. So it's very important to monitor your actual rate when you are operating under a provisional rate. As I said, there are different types of bases. That's when we remember when we were looking at calculating the ratio, we take our pool divided by our base to get our rate. The different bases are modified total direct, direct salaries and wages, direct salaries, wages, and fringes. So those are the only three bases that you can use. So the modified total direct are all your direct salaries, wages, fringes, materials, supplies, and subawards up to the first $25,000. So that's your modified total direct costs, the direct costs that get charged to a program. What gets excluded from those direct costs is equipment, capital expenditures, participant support costs, and the portion of a subaward that is in excess of $25,000. So what it means with the subawards is that you can only collect your rate on the first $25,000. Anything over that you cannot charge your rate to. And this modified total direct base is the base that is used for the 10% de minimis rate. So you might opt to use direct salaries and wages, or you might opt to use salaries, wages, and fringe. So let's look at an example of these different bases. In this example, my pool, my indirect costs pool, are $1,501,633. That pool does not change regardless of the base that we're using. So in this example, my base is total modified total direct costs. So I take my indirect cost divided by my base, and I get a rate of 10.41%. Now, if I change my base to salaries and wages, okay, so I'm only looking at salaries and wages, my rate becomes 18.44%. If I use salaries and fringe, then my rate becomes 12.5%. If you apply these rates times the base, you will always get your indirect costs. So you're not receiving more than what your base is. So as you can see, the rate varies based on the base that you're using. The bigger the base, the smaller the rate. See, big base, small rate. The smaller the base, the bigger the rate. But you're only recouping what is in your pool. What are the advantages of negotiating an indirect cost rate? Well, one of the advantages, it provides one method to allocate almost all of your administrative costs. So you're not looking at different allocation methodologies. You're not looking at number of employees and number of computers and square footage and number of transactions. It's one method. Everybody gets charged the exact same rate. And it could potentially make budgeting easier. If direct salaries is our base, and you know what your rate is, it's very easy to determine how much indirect costs a particular program is going to be charged. And another advantage is that the rate and the method are federally approved. Now, what are some of the disadvantages? The rate and the method are federally approved. Wait, didn't I just say that was an advantage? It is, but the disadvantage is that it's subject to the individual cost negotiator's preference. Now, we say this is a negotiated rate. There's not a whole lot of negotiation that goes on. You submit your application, the rate negotiator tells you what your rate is. Another disadvantage is that you could lose some flexibility in how you determine the manner at which programs are charged. So if you're using a direct methodology, and your allocating costs may be based on number of employees, and you say, I'm not sure that number of employees is the appropriate methodology. Let's try to find another non-monetary base to allocate. Well, you have that flexibility if you're using the direct method. If you're using the indirect method, you lose that flexibility because you have to charge your rate. Another disadvantage is that you may need to have it finalized every year and get approval, so that takes administrative time. And there are also inconsistencies in charging the rate to non-federal funding sources. As I said, all of your federal awarding agencies have to accept your methodology using that rate. Your pass-through entities that are passing through federal dollars to you have to accept that rate. But you might have other funding that isn't subject to federal rules, and they might not accept your rate. It might be United Way funding. It might be a foundation. It might be local state money or local or state funding that may not accept rates. So that's certainly something that you have to keep in mind. Now, let's talk about cost allocation plans and what does it mean to have a plan. And the regulations say that you must have written procedures for determining the allowability of costs. So how do you determine if that cost is allowable? Now remember, we went through the factors that do affect allowability of costs, so that's something that you have to keep in mind. Your cost allocation plan should be the simplest, most straightforward way to fairly allocate costs. Don't create convoluted, complex methods that are hard to follow, that take a tremendous amount of time and effort to do the calculation. It doesn't have to be difficult, but one of the things that is important is that the plan must easily communicate that the agency is distributing shared costs fairly and following the regulations. Another way of saying that is that you need to be able to explain your methodology. It can't be that, well, someone else created it and we just follow it. It's really important for who's ever doing the allocation that they truly understand it, that they can understand how its allocation is based on benefit, and that everyone is being treated the same way. Your cost allocation plan should also have a description of the process. So the first is the how. Through an allocation module in your accounting system, spreadsheet, separate software, manually, how do you actually do the allocation? We program our software to do it. We run a spreadsheet. We use other software. However it is, how do you do cost allocation? And then the when. When do you do cost allocation? Do you do it monthly? Do you do it quarterly? Or when do you check it? as we said, it has to be a reasonable approximation. So you're monitoring it pretty regularly to say, yeah, this methodology is still reasonable. It might not be exact every single allocation, but sometimes it's a little over, sometimes it's a little under, but in the scheme of things, we're okay with it. So when do you do that, and when do you check it? And finally, who has that responsibility to make sure that the costs that we're charging are allowable and allocable? And this should also reference your approved financial policies and procedures that you have in place. Your cost allocation plan will provide information on the sources of revenue for each program, including any statutory limitations. So statutory limitations means what's in the law that limits what costs that they will pay for, such as Head Start has a 15% limit on administrative costs. Some workforce development programs have limits of 5%. So your cost allocation plan should talk about, this is the funding, this is what's different about this type of money. These are the limitations. These are the things that we have to keep in mind. Now, remember what I said though, you don't stop allocating to a particular program just because they run out of money, because you cannot shift costs to another federal program to overcome a fund deficiencies. But these are just things that you need to keep in mind when you're doing your cost allocation. Your plan should also describe the costs that are going to be allocated. The administrative services such as human resources and accounting and the executive director, make sure that what costs go into those allocation methodologies. And then you need to describe the methods. So what is the distribution based for shared costs? Direct costing would be an activity based, maybe like number of children. Or if you're using an indirect rate that you're using, your base is salaries and wages. So what is your base that you're using to allocate these costs? And how will indirect costs be charged? Do you have a negotiated rate? Do you have a de minimis? Are you using the 10% de minimis rate? Or do you not use any rate at all, that you use only a direct allocation methodology? So this is an example of a cost allocation chart. So we start with what are the actual costs that we're trying to describe in this allocation methodology. So the first one, we're trying to find a way to allocate our human resource department. And these costs include all of our human resource staff, their salaries, their wages, their benefits, and the space that the HR department actually sits in. What is my allocation base? Number of employees in each program. So I take all of my costs and I determine, all right, I have 100 employees. 50 employees sit in one program, so 50% of my human resource department is going to be allocated to that program. And the rationale is that the number of employees drives the need for the HR staff and their resources. Where does HR spend their time? Well, they probably spend their time where the most employees are. So allocating based on number of employees is a reasonable method, and it's documented. The next example is facilities management costs. So all of the facility staff, our maintenance workers, their salaries, wages, and benefits, and any supplies that they use. What is my allocation base? Number of square footage. And what is the rationale? That the number of square feet maintained correlates directly with the facility department costs. So the more space there is, that's where our facility people have to be spending their time. So I think as you're going through this, you're kind of seeing that it makes sense. And that's what you really have to think about with your cost allocation. Does it make sense? Does it allocate based on benefit? And that's what you're looking for when you're looking at rationale. All right, let's go on to the next slide. When do you do direct cost allocation? Well, there are two different methodologies. One is real time and one is month end. So real time says that you allocate as soon as the cost comes into the system. When I pay rent, I allocate to the programs based on square footage. When I pay that utility bill, I allocate it to the programs based on square footage. When I get the insurance bill for that billing, I allocate it based on square footage. So that's real-time allocation. Month-end allocation says that you would pool these similar costs and then allocate out this total pool at the end of the month. So when I pay rent, it goes in to the occupancy pool. When I pay utilities, it goes into the occupancy pool. Insurance goes into the occupancy pool. And then at the end of the month, I make one allocation to all of my different programs. Either one of those methods are allowable. It's just whatever works for you, and looking at your accounting system to say what makes the most sense. So cost allocation plan implementation. The allocation method you use is a management decision, not a funder decision. Sometimes there are funding sources that want to tell you how to do your organization's cost allocation. And I really have to stress that this is a management decision. It needs to be supported in your fiscal policies and procedures. You need to document, review, and update your cost allocation plan on a regular basis, whether you're using a negotiated rate or the de minimis, or you're using a direct allocation methodology. And you need to classify costs. You have to determine if costs are direct or they're indirect or they're shared costs. So when you set up your system, you have to decide how these shared costs are going to be accumulated and allocated. Again, are they going to be done real time or month end? You're going to look at your indirect costs and see how those are accumulated. Are they, is that done within your accounting system? Do you have a separate P&L for those indirect costs? And you want to make sure that your distribution methods are updated on a regular basis. How often do you check those allocations? And that should be documented in your policies and procedures as well. And you want to allocate, make sure you're allocating shared costs using the indirect rate if you have one. And then make sure that you train staff to understand and know how your cost allocation plan actually works. So what are some common findings that we see with cost allocation plans? The first one is that you're not allocating all shared costs to all benefiting programs. We see agencies stop charging to that grant that only allows 5% admin because we've reached our 5%. Now, if you remember, you can't stop allocating just because they won't pay. You need to make sure that they're allocating as long as there's a benefit. Another common finding is that agencies not getting new indirect cost rates on an annual basis. Not revising their cost allocation plan or indirect cost rate proposal to include the addition or the loss of a program, and not maintaining supporting documentation. So these are all things that we see related to cost allocation that sometimes gets organizations in trouble. So other things that we've learned is that the first is that if you change your cost allocation method, you're going to get a different result. So for example, if you're allocating based on square footage and you switch that method to number of employees, you're going to get a different result. If you're using an indirect cost rate and you're using direct salaries as your base and you change to direct salaries and fringe, you're going to get a different result. So it's really important to understand the methodology and make sure that you're charging in an appropriate manner. Communication with program managers is important. We have a webinar on budgeting, and so if you haven't listened to that one yet, I suggest you listen to that one. But program managers and fiscal are both involved in the budgeting process. And what program managers or program directors know, they know their direct costs. They know what it costs to actually operate the program. What they may not understand so much are these shared costs that they get charged. So make sure that they understand what gets charged to them and why, and so that they understand, hey, I'm being allocated based on benefit. I'm not just paying the most because I have the biggest program. So just make sure that they understand the value of what they're receiving, that they understand that they're paying their fair share, that everybody pays a part of it. Because sometimes there can be some challenges, some cultural issues around cost allocation when individuals may not fully understand the methodologies. So some things that you need to keep in mind is that if you have a subrecipient, that or you are a subrecipient, that pass-through agencies have to accept the negotiated rate, or they could negotiate one with them. Approvals have to be based on the uniform guidance, and procedures followed in evaluating and approving a subrecipient's indirect cost proposal should be documented and are subject to review. Now, what about grants that disallow or limit the amount of administrative costs that they will pay you? Keep in mind, as I've said before, you're required to charge all programs fairly and follow your plan. So I cannot stress this enough, that you allocate first and report second. So you request reimbursement from funding sources according to the grant requirements, but you charge costs according to your plan. And when we're considering and thinking about cost allocation, we're aiming for fairness, not precision. It's not going to be exact, as I told you. And each program needs to pay their fair share. That's what cost allocation is designed to do. Simpler is better. Can you easily explain your cost allocation methods to managers and funders? Don't make it complicated. It doesn't have to be, as I said, convoluted or complicated or really complicated or convoluted was the word I'm looking for. And lastly, don't spend $2 to allocate a dollar. Are nested allocations worth the effort, where you do one allocation on top of another allocation on top of another allocation? You're spending a lot of time to find a way to allocate $1. So don't spend a lot of time splitting pennies. Design methods that can be done in your accounting system. Let's make it easy on you. Use distribution codes or cost pools, or use a cost allocation module. And we caution the use of spreadsheets because we make mistakes with spreadsheets, or something might not be updated correctly, or we have a bad formula somewhere. That can throw off your cost allocation pretty quickly. The other thing to keep in mind is you're never going to find a methodology that everybody loves. And that's okay. We're shooting for fairness, right? We're shooting for a simple allocation methodology. And when you apply for a grant that has little or no administrative dollars, plan on how you will cover those costs before you get the grant. Every grant that you have incurs administrative costs. You apply for a grant, and the executive director has to sign for that grant. So it takes part of their time, and you want finance to pay their bills and receive the money. So the finance has to be involved in that program, and you want people to actually work in that program. So you need to have HR involved. Oh, and you want those people to use computers? Well, we're going to have IT involved. Oh, and you want them to sit at a desk somewhere? Well, there's going to be some facilities and space costs charged to that grant. So every grant incurs administrative costs. And if they don't pay their fair share, you have to figure out how you're going to pay for that, because as we said, you cannot shift those costs to another program. If you have multiple funding sources, cost allocation is unavoidable. So that's something that you just make sure that you understand. You deal with it on a daily basis, but don't make it consume all of your time. And the results of cost allocation may force you to critically review your administrative costs. Are they too high? When you really look at the costs that you're charging, is there some way, and if you have grants that really cannot recoup that, then is there some way that you could reduce some of those costs? So I want to thank you for joining the webinar today. Hopefully this has given you some insight on cost allocation and indirect cost rates. We do consulting around this area. We offer a lot more training in this area, and please feel free to reach out to us if you have more questions. Again, thank you for joining today's webinar.